It's a bull. Good morning. Hey, what's up? This is Brian Kuzmar with Commercial Rare Coins and Precious Metals in beautiful, rainy, overcast Lauderdale by the Sea. A little cool out there as well. Got to have these rainy days, I guess, to appreciate the sunny days, huh? Well, take a look at this cam. Pretty cool. South Florida cam, too. West coast of South Florida, but no less. The Live Eagle cam. This is on YouTube. You can watch it yourself. I've been watching it for a little while. Mama taking care of her little eagle babies here. Not many people know that Florida has quite a few eagles that reside in our state. Take a look at the dinner here, too. I'm trying to figure out what kind of fish that was, but it appears to be a fish dinner, I think. Well, anyways, take a look here. That's the Southwest Florida Eagle Cam Live. Pretty cool cam I just discovered. Figured you guys might enjoy it as well. Let's take a look at spot prices today. Kind of a little bit on the upside, I would say. I believe the coin is correct today with its bull. Bull side landing up today. So let's take a look at spot prices. They're currently sitting at 1813.67. A low overnight since yesterday's close of 1800 and a high of 1813 where we sit right now. So it looks like it's making its highs currently. And what time is it right now? Let me take a look. It is 11:16. Sorry, I got this video done a little bit later than normal. I like to get them done earlier if possible. But no less, take a look at this. Up market today for gold, silver as well. Currently sitting at 22.65, a low at 22.47, a high at 22.69. And again, looks like it's made the high just here recently. And platinum sitting at 963.14, a low of 941, and again, sitting at its high. And palladium, again, we don't talk about palladium much. Why don't we talk about palladium? Because it's very few people buy it. I think we sell for every 10,000 ounces of silver, we sell 1 ounce of palladium. It's probably the same for gold, every 1,000 ounces, even more than that, thousands of ounces. I think we sell very little palladium, mostly an industrial metal. How many of you own palladium out there? Make a comment below and let me know. Let's take a look at the 24-hour spot price on gold and see where this up market has taken place. And it's pretty obvious. Let's see here, January. There's Sunday night's market. There's yesterday's market. And as you see, New York kind of drifted down before New York even opened yesterday. I was suspecting that the gold bid gets hammered in most likely London, it looks like, or maybe on the New York Lobex markets. Both of them crooked markets, in my opinion, as is the Crimex, or I should say Comex market there. But no less, there's your drift downward, and then she's kind of moved back upward to where we are today. Drifted sideways last night. There's a green line from last night. Here's this morning's New York Open. See the 8 a.m. right there? So there's your New York Crimex Open right there. Up a little bit and blip. And again, almost a rubber band effect that we've been seeing when we've seen these little monkey hammerings that have been occurring recently. For a while there, the monkey hammerings were just occurring in the morning, and the line would drift down like this. Instead of that going up like that, it would kind of drift sideways through the day. But it seems like the last couple of weeks we have seen this rubber band type effect. We've seen it get hammered in the mornings in New York, and maybe even before New York Crimex opens on the Globex or London markets with gold. And then we see it kind of rubber band back. I'm calling it kind of the rubber band effect, the snapback. Because it seems to happen pretty quick. Yesterday's lines were in silver were really tight, but again, seeing the rubber band working right here, and it snapped back and even kind of higher than where it originally started at. So this is a good sign that we're seeing here. Even if we're taking 5 steps forward and 4 back, we're still moving forward here, folks. So it's a good sign overall. Let's take a look at silver prices too, the 24-hour silver chart. I'm going to do a quick refresh there. And again, you see kind of the same pattern yesterday, except unusual what I've noticed. And again, I notice patterns because I got to watch this market every day, 5 days a week for years now. So you do notice patterns when you watch something all the time. It's like watching children grow. You notice every little thing that goes, or everything that grows on, or whatever's going on. And take a look at the yesterday's market, which perplexed me a little bit, because most of the monkey hammering we saw in silver was done in the opening for the last, for a while, for months now, in the opening in New York Crimex markets, which would have put that red line right about here, typically. But yesterday, either London or New York, and London, I don't think there's a lot of trades in silver in London. I'm suspecting, again, just conspiracy on my part, because I don't have the data to show me where large trades like this took place to drive the price down. I don't think it happened with silver in London. More than likely, the Globex markets, which is owned by COMEX. That's my name. That's what I call them. A lot of people call them COMEX now, in my opinion. And it happened before New York even opened, and then it kind of steadied out at New York. So kind of this is a strange trading pattern I have not seen for quite some time. And if you've been watching my videos here, you know we look at the 24-hour chart quite a bit. You'll have noticed the same thing, that the monkey hammering took place earlier than we've been seeing it happen in the New York COMEX markets. So what do you make of that? Put your comments down below if you got some ideas and thoughts on that. Let's take a look at the stock market right now and see what it's doing. Overall, kind of, looks like last night futures were in the red somewhat, and it looks like the Dow Jones is down a tiny bit, 68, which is, a drop in the bucket for a 35,000. We're sitting at 36,000. My gosh. And the S&P has kind of recovered, so back in the green there a little bit, at least for today. Not quite sure what that means. We do know that we got Fed jawboning going on today. I'm pretty sure. Was that today? I think it's today. We got Fed jawboning on, so might see some interesting things in the market. And perhaps this is why we're already seeing the markets, Dow and the SP, NASDAQ, in the green, and even gold and silver in the green as well. Kind of interesting. Maybe Powell said something that caused these markets to move, which wouldn't surprise me. Crypto's the same way. Cryptos seem to be up across the board a little bit. Take a look at that. That was near 40,000. And why am I talking about cryptos? Well, it's part of the space out here. And I'm really I'm constantly amazed at the volatility of the stuff. It's like a casino. It is alluring to some degree because you figure, hey, I can put some play money in here and see what happens. But you know what? I think the days of cryptos making people millionaires is over. It's over. I don't think anyone's going to become a millionaire by trading Bitcoin anymore. The reason people became millionaires because they were in at levels that were long-term. The long-term holders, they made a lot of money. And maybe people that had a lot of money to buy one Bitcoin at 29,000, and it went to 60,000. So you basically doubled your money there. But that's for big whales. People that are already millionaires can buy more than one Bitcoin. The average Joe trying to get rich on Bitcoin, I think it's over. I think it's been over for a long time. I think the time that you would have got rich with Bitcoin if you were one of the original investors and you were back at these points right here and you had loaded up some, even maybe at these levels, and then when they hit these levels, but you had to buy a lot too. So the average Joe, could spend what? I don't even know what the average Joe would spend on Bitcoin. The average working guy that made $100,000 or less per year, $80,000 to $100,000. How much can they afford to buy? A couple Bitcoins or something like that. So becoming a millionaire with Bitcoin is a pie in the sky fantasy unless you have a ton of money and you speculate properly. But no less, looks like that the whole sector is up today, as are gold and silver, precious metals, and even the equities are up today. Let's take a look at a Peter Schiff article that I want to read real quick to you. I like Peter Schiff, love or hate the guy. He is a gold bull, and he is very outspoken against cryptos, kind of like me, but he's a little bit too harsh. I don't diss anybody for wanting to go into cryptos. I'm a capitalist. I think, hey man, you can be able to spend your money on whatever you want. You want to go to casino, fine. You want to go to the crypto market, fine. I'm cool with that. And if you make money, I'm really happy for you, genuinely happy. But no less, I find crypto markets like Peter does is maybe a short-term thing. Governments hate competition, so do banks. Peter understands that, as do I. And the best they're going to become is just relegated to, like in the United States, they'll be relegated to a glorified money market account, maybe a highly speculative one as well. But as far as the speculation goes, I think because now that you've seen the Bitcoin and others turned into financial instruments, that you're going to see that that volatility may even just go away. As I said, it may just sit places for a long time and start acting like a stock somehow. Again, which is not going to make anyone a millionaire for sure. However, if you're investing in things to become a millionaire, I don't know. You got lots of risk. Means high risk means that you have a high chance of maybe making something as well, a lot of money. So big gains sometimes require high risks, and maybe younger people can afford to do that. But if you spend the first 40 years of your life making your money, you spend the second 40 years trying to keep it. So what part of your life are you at? In your life are you right now? I think if you're in the preservation part, I would definitely stay away from cryptos, and would definitely more be in gold. That's my opinion, gold and silver. But let's read Peter Schiff's article. I kind of went off on what Peter Schiff and I have in common. And let me take a look here. The Fed FOMC minutes came out last week, signaling tighter monetary policy. Peter Schiff talked about the minutes in his podcast, arguing that the Fed can't do what it says it's going to do. If it does, it'll crash the markets and the economy, and it won't lower inflation. Of course, this is something that we've been talking about on our video for the last year or more, a couple years. What the Fed does plays a big role in the overall economy, which has a big effect on the price of gold and silver, obviously. Let me get a sip of coffee here real quick, sorry. 3 that time. The Fed minutes were widely viewed as even more hawkish than the messaging coming out of the December meeting. Peter said the minutes even surprised him a bit, but he reminded us that he's talking about a hawkish Fed. He's not really talking about hawks. Peter nails it on this one, in my opinion. Peter says about hawks, he says, they're extinct. They might as well be a dodo bird at the Federal Reserve. That's pretty funny. Everybody is a dove. We're just talking about degrees of dovishness. And so the Fed was less dovish than the market had expected. Peter, really, words mean something. And we're finding that out more and more and more. And Peter points out very correctly that they are extinct. Hawks at the Fed are extinct. They're basically just doves, and it's how less dovishness they're going to be is what we're really saying here. Let me move on to what Peter says. I can add my own comments later. The minutes indicated we see 4 interest rates hikes this year. These hikes were widely anticipated after the meeting. That would push rates up to about 1% by the end of the year. Whoa, 1%. Remember what we were talking about yesterday? In the big scheme of things, and against the backdrop of the current economic data, that's not a lot. Exactly. You can't describe those itsy-bitsy moves in any way hawkish. And this is what I've been saying for a long time. It's jawboning. They're jawboning this. The captains of the Titanic are jawboning the passengers. Well, let's not call it Titanic, because that was a respectful captain. He went down with his ship. The current Fed chairman, they don't go down with the ship. They just replace him with a new one. And he goes on to work in the private sector and get rich. Big deal. But no less, the captain of this sinking ship is not any way hawkish at all. Okay, let me move along here. But comments regarding quantitative tightening, shrinking the balance sheet, really roiled the markets. In other words, they're going to go from a massive buyer in U.S. Treasuries. Think about this. This is not so much with the interest rates, but Peter's referring to the buying of treasuries, the buying of bonds, the buying of mortgage-related bonds the Fed's been doing for quite some time. This is what taper really means. Taper means tapering off their asset purchases. But does taper mean that they're going to lay off these purchases that they've made, start to reduce these purchases? Let me keep going on with what Peter says. In other words, they're going to go from being a massive buyer in U.S. Treasuries and mortgage-backed securities to sellers of those securities. I'm not quite sure if they're going to become sellers of those securities. Maybe they'll just hold for a while. I wonder what Peter knows, or I wonder where that information comes from. And Peter's probably correct. He knows better than most. And that's what really spooked the markets, because we sent the bond market tanking. Yields on 10-year treasuries hit a 52-week high and briefly pushed above 1.8%. If the Fed is going to shift from buying bonds to selling, clearly that'll put heavy pressure on the bond market. But Peter said there's one thing that the markets don't seem to comprehend. He's absolutely correct. If the Fed actually follows through with this plan, if they actually start to shrink their balance sheets, bonds aren't going to just fall, they're going to crash. They have a long way to decline. Again, I'm wondering if the Fed does taper, they're going to reduce their buying by, does this mean that they're going, when they say reduce tapering, does it mean they're going to reduce their buying? Again, I'm a little bit unclear about this. I may be ignorant on this subject too. If any of you want to make a comment down below, I'll find out afterwards. But taper, does that mean they're going to just stop the purchases of assets? Or are they going to start selling some of those assets? They were spending $130 billion a month or something buying bonds and treasuries and all this stuff, mortgage-backed securities. They said they're going to taper and reduce it to 115 billion a month. But does that mean, again, that they're going to sell the assets they've already secured? That's a big question. I don't think they can. They may be able to back off on their purchases, but I can't see them selling this stuff. They're going to flood the market. And I think that's what Peter's going to get into right here. Peter said that why he doesn't think the Fed will actually follow through with this tightening plan. I mean, sure, they can talk about it, but doing it is a whole different thing. But the market still doesn't understand how bad it would be. The only reason interest rates have dropped as low as they are is because the Fed has been massively intervening in the bond market, and because a lot of people were under the impression there was no inflation. If we have a 6.8% inflation, the Fed is selling bonds, why would you expect yields on a 10-year to stay at 1.8%? Absolutely. I mean, math doesn't lie here, man. If the Federal Reserve is no longer buying any treasuries, in fact, again, selling treasuries, and the U.S. government is selling treasuries, and the various trust funds like Social Security Trust Fund are also selling treasuries, everybody's trying to unload low-yielding treasury. What private buyer is going to buy them? None. Really, nobody's going to buy a 10-year treasury yielding 1.8% when there's a 7% inflation rate. And that's absolutely correct. Why the talking heads, well, I know why, corporate talking heads are morons. You know, when CNBC, Wall Street Journal, Bloomberg's, none of them talk about this stuff. All they do is they parrot what the Fed says, and they parrot what their bosses tell them to say. Well, anyway, I digress here. Let me move along. And Peter points out clearly, asking us, myself and yourself, even if inflation comes down to 3 or 4%, why would you want to loan money at 1.8%? Right? Does that make sense to you? You wouldn't, and that's absolutely true. Why corporate media, especially the financial talking heads out there, don't discuss this? Well, I know why, because they're in bed with the Fed. How you like that, in bed with the Fed? They're just job owning these markets as well. Maybe that's what their job is supposed to be, job own these markets. But you know, the fact that they don't bring this stuff up, the simple math of the whole thing, real rates versus nominal rates, and what's actually happening here, you wonder why they don't bring it up. Maybe corporate news is also involved with keeping the passengers calm. That's just a conspiracy on my part, though. So the reality is, if the Fed actually does what it says it's going to do, the bond market would crash, which again is why it's not going to do it. The same thing with all those rate hikes. If the Fed continues to raise rates, not just 2022, but 2023, the way they're indicating, the economy is going to move into a recession. The stock market is going to move into a bear market. Something is going to happen that is going to cause the Fed to do an about face. Well, the assumption is, by Peter, is that the Fed is going to look out for treasuries, and the Fed is going to look out for, but maybe it has to. Maybe the Fed is reliant on making sure treasuries don't collapse. But again, remember the Fed has the unlimited printing press. Never underestimate the people that have the printing press. Could the Fed say, screw it, we don't care, we're going to raise rates like they did back in the 1980s up to 12%, which, if you remember, did knock down the price of gold as well. Can they even afford to do that? I don't think they can. Will the Fed will the Fed throw the stock market, equities market, mortgage market, and treasuries under the bus? Well, it's possible, I guess. It's possible they could do that. Maybe they'd bail them out. I don't know. Again, never underestimate the people with the printing press. So Peter says the reality is if the Fed actually does what it says it's going to do, the bond market would crash, which again is why it's not going to do it, according to Peter. The same thing with all these rate hikes. If the Fed continues to raise rates, not just, I read this already, the economy is going to move into the recession, the stock market is going to move into a bear market, something's going to happen. Yep, I read that. Sorry about that. Well, that's okay. We got time. So moving along here, Peter said it's amazing to him that people can actually call a proposed Fed policy of gradual rate hikes as being hawkish, or that is in any way a tight monetary policy designed to fight inflation. In 2002, the economy went into a recession that coincided with the bursting of the dot-com bubble and the 9/11 attacks. What did the Fed do in 2002 to stimulate the economy? It slashed interest rates to 1%. Now, if you remember, folks, a lot of us know that are in the bullion business that the bull market for gold and silver started around 2001, 2002. Might have had something to do with those extremely low interest rates as well. Now that I'm thinking, an afterthought, in retrospect, I should say. That's kind of interesting. Now, a lot of people don't realize that these bull markets, again, the 2012 bull market that we saw when gold topped out at 19 or 2000 or something like that. Silver was almost $50 an ounce in 2012 before it got legally monkey hammered by JP and others. But anyway, I digress there. That's when the gold market really kind of started to take off in 2001, 2002, right about this time. So they slashed interest rates to 1% in 2002. And I don't know how many of you remember that. At that time, unemployment was 5.4%. The CPI was 1.58%, and the GDP grew by 1.7% in 2002. Against that backdrop, the Fed was stimulating at lowering interest rates to 1%. Based on these numbers, 5.4% unemployment, 1.5, they were stimulating the economy. Peter points out pretty clearly and factually, today the unemployment rate is 3.9%, which is even lower. GDP growth is projected to be at 5.6%, which is even higher, again, because the economies are kind of opening up. And the CPI is at 6.8%, which is hugely much greater than it was at the time in 2001, which is 1.58%. So here's your two big differences in numbers. They lowered to 1% then, but remember the CPI rate was 1.58%. We're still at that low interest rate, and the CPI is at 6.8%, as Peter points out right now. Big differences here. So Peter says, so with these economic numbers, the Federal Reserve is proposing that it gradually raise interest rates so that by the end of the year they may be all the way back up to 1%. The same rate of interest was considered highly stimulative in 2002. Now it's considered tight money. Isn't that interesting that then when they lowered interest rate to 1%, that was considered tight money, but now it's considered tight? I mean, come on, that's hypocrisy at its greatest, and this is why I say all the Fed does and all corporate media does is a jaw bonus. They jaw bonus because the ship's going down, and they don't want us panicking because you know why? They're still making money off you. That's why. And Peter says here, when are people going to figure out that even if the Fed does what it claims to do, it will do nothing to cool inflation? Excuse me there, wanted to make sure got that thing all right. And it may not even do that based on the weakness in the market and the economy that will result. So really good article by Peter. Sorry, I called you Pete, like I know him. Good article by Peter Schiff. The Fed can't do what it's saying it will do. It's in ZH. You can read it for free here. That's what I like about ZH. They get all kinds of different cool articles. And I'm going to carry on this subject without going into my typical politics, economics, which I like to do on ZH. You all know my opinions on a lot of this stuff anyways. How moves in the Fed fund rates affect the U.S. dollar? Okay, because this is important as well. You can read this in Investopedia. I think I was telling you yesterday, if you ever see terms or words that you're not familiar with in the economic world, in investing world, look at Investopedia. They know everything. It's one of the best encyclopedias of economic and investment terms out there, and they explain it very in layman, simple terms to you. How moves in the Fed funds rate affect the U.S. dollar? I'm not going to read the whole thing because, again, we could be here all day reading articles. Great read, suggested reading on my part. Go to Investopedia and type in how moves in the Fed funds rate affect the dollars. I'm going to read the key takeaways here, which they give you, like the Reader's Digest version of what they just wrote. When the Federal Reserve increases the federal fund rate, it typically increases interest rates through the economy, which tends to make the dollar stronger. The higher yield attracts investment capital from investors abroad seeking the higher returns on bonds and interest rate products. Increases or decreases in the Fed fund rates have correlated fairly well with moves in the U.S. dollar exchange rate versus other currencies. Now, some people, this may be Greek. Again, this is why I think it's very important if you're investing in gold and silver and doing any kind of investments, you need to really understand the terms. You need to understand what Fed fund rates are. You need to understand how they affect the U.S. dollar. You need to and I'm learning too. So let me not pretend that I'm an expert in all this stuff. Believe it or not, a lot of these videos that I do, I learn as I'm trying to show you. And basically, that's the whole point of my videos here, is to share what I'm learning as I go along in my life. And hopefully I'm sharing things that are helpful to you as well. But good article, suggested reading, how moves in the Fed funds rate affect the U.S. dollar. Let me see if there's anything down here that I kind of missed that I wanted to talk about. read the stuff over before I even show you to pretend that I understand it. No, just kidding. To gain some understanding or take some key points that I want to talk about. And oh, come on, let me see here. How the dollar helps with inflation. The example of Fed funds in the U.S. dollar. Let me see here. I think this is a little key takeaways. Examples of the Fed funds in the U.S. dollar. And in Grayer's, in the 1990s, the Fed fund rate rose about 3% to eventually 6%. You know what? I think if I started reading some of this, it wouldn't make sense to you because you really have to read the whole thing. Again, suggested reading. It's not homework. Everyone hates homework. So did I. So I'll call this suggested reading for the day. And if you read this kind of stuff, trust me, you'll be smarter than the average bear. That's for sure. GDX, assessing the damage from the Fed minutes. This was written yesterday, I believe. Today, I'm sorry. The GDX appeared to be mounting recovery until the release of the Fed minutes on Wednesday reignited concerns over accelerated Fed tightening, a shift from deeply negative to slightly negative real bond yields, which still undermine gold mining stocks if there's history is any guide. However, a repeat of the 2013 taper tantrum on GDX seems highly unlikely. He's got a point here. He talks about going into, a shift from deeply negative to slightly negative real bond yields, which still undermine gold stocks if history is any guide. I really didn't get a chance to see where he points out that the gold has been gone down over negative real rates. I guess it has. We'll take a look at some charts here in just a tad. Another really good article you can read for free. All you got to do is go to Seeking Alpha, go to Markets right here, Market Outlook, and I'll show you. I hit Market Outlook, Navigating the World of Inflation, and I think I just lost the article. I guess they updated it 1 second here. Where is it? GDX section. Okay. Well, anyways, good article on here. If you type that in right there, I'm sure you'll pop up in your search engine. I like to use DuckDuckGo. Good article here, but he's mentioning that even negative interest rates by the Fed saying that they're going to raise interest rates, nominal rates, and it's still, real rates will still be in negative territory if you understand, again, what we talked about yesterday. It's a little confusing for some people. It was a little confusing for me when I first started learning this stuff as well. But negative rates, even if they raise rates, the Fed does, you're still going to be in negative rate territory. And this gentleman feels and says that in the past it has hurt the gold price, but I can't see why, if people are still getting a negative return after inflation and everything on bonds, treasuries, you name it, why would they invest? Why would they invest in it? Just as it makes gold would be such a better place to be. And again, why I think it happens, I think there's a general narrative that the Wall Street Journal and the Bloombergs and all the corporate talking heads and the Feds talk about. There's a narrative that they have painted that when rates go higher, people are going to stick their money into treasuries and bonds and such. And the truth of the matter is that it barely ever happens. There's very few times where rates actually went positive above the real rates. I mean, we'll take a look at that chart in a little bit and we'll talk about that. But I can see how it happens. I can see how gold would be undermined and mining stocks would be undermined by a shift from deeply negative to slightly negative. And again, not because there's any returns or it's a better deal or that there's any real reason why a smart person would go into bond yields instead of gold, even at negative rates. There's no good reason for it. It's just a narrative. It's just a bullshit narrative, and I've been saying this for a year. A bullshit narrative that's been painted by corporate news, talking heads, and people that don't really have a clue what they're talking about. And narratives can change markets. You know that as well as I do. Lies can change markets. Narratives can change markets. And if the general public has that narrative that higher rates in bond yields will make gold unattractive, as soon as they hear higher rates, that's all they hear. They don't understand. A lot of the vast majority of the public doesn't understand nominal versus real, okay? They don't understand that, yeah, you may be getting 4% 3% a return on a bond or a treasury, and that's not even true. It's half of that. But if the cost of living is 5%, you're losing 2% a year. Most people don't understand that. A vast majority of the public doesn't get that. They don't read this stuff. They don't care to learn. And again, this is why I'm sharing this stuff with you as well. Most of you know this, so that's why you buy gold. Let's move into the charts just to kind of take a look at the charts. Federal fund effective rates. This was interesting. This is based on repo rates or overnight kind of funds. My understanding is what they charged. Say for example, a bank has some liquidity issues. They have these, the Fed will loan them money overnight at a certain rate. But look at what they were charging prior to 2019. My understanding too, in 2019, they were loaning a shit ton of money to overnight, to a lot of banks. I think just recently it broke that it was. The Fed had loaned lots of money to Deutsche Bank or something like that. And Deutsche Bank, JP was heavily involved with Deutsche Bank, so maybe that's the reason. Deutsche Bank, whatever. They were gold manipulators too, isn't it funny? You think about it? But they were the ones that were in big trouble in 2019, supposedly, and were making big use of this overnight borrowing. But take a look at what happened to the rate of that overnight borrowing. Look at this, 2.38%. So it means that a bank could borrow and pay it back, I believe, overnight. And again, if I'm wrong, anyone is watching this, I'm learning this myself, this particular part of economics. But if I'm wrong, let me know in the comment section. But from my understanding, this is the rates what they charge to loan these entities money overnight to keep them liquid. But look at what, during 2020, look what happened to that overnight loan rate. I mean, it just went to basically nothing. So this is interesting when you look at it with other charts. Gosh, I'm kind of getting into these charts. I'm getting into this and trying to see correlations between things. There's the current U.S. dollar index as well. Take a look at this chart. I'm going to do let's do it all here and take a look at where we are currently. And boy, that's all? Really? It doesn't take us back that far. I kind of want to go back to, let's see here. Year to date, all 3 years. Let's just look at a 3 year. Oh, I know what they did. Okay, you got to go back here. There we go. All right. Anyway, I don't like market watch charts. But if you take a look where this is January, I was looking for a yearly chart. Sorry about that, folks. Didn't mean to waste 30 seconds of your time there. This chart we looked at yesterday as well. It's kind of interesting. Let's point out the bull markets. Now, I tried to look at all. This chart only goes back to 2003. However, let's take a look at... oh, jeepers. Sorry about that. Let's look at the 20-year chart here. And there's the real yield, okay, on a 10-year treasury, 1.96%, kind of hovering there. There is the low, 2.83%. And where does that 2008? This is right around our market collapse. Towards the end here. That's when the 2008 recession, the big, everything was going to end that week. But that's that right there. And you can see a little blip in the price of gold. Gold goes down a little bit, of course. Gold goes from that point, 2000. And remember when I was telling you the bull market in gold started in 2001, you see that rising trend line right there? Time in the 90s, that thing just sat flat. So really the bull market of 2012, as I told you, really started in around 2001, and you can see that slowly rising line. It probably has something to do with the real yields as well. However, over time, gold's gone up substantially, and the yields have not really gone up that much. Hold on one second. Let's take a look at 2012. And where's our peak in gold here? Looks like we have, I'm looking for my $1,900 mark. And where is it? There we go. 1836. I think it was close to 1900 or something like that. I feel it was even higher than that then. But I can't seem to catch the high. But look what the 10-year treasury yields were, 0.1%, okay? 0.10. When people say rising rates, let's see, let's go up here again, minus negative rates, that's negative on a 10-year yield. I'm looking for some positive rates on a 10-year yield. There we go, 2016. Gold was kind of in the slump during this whole time, and if you look, really, 10-year yields were really basically nothing. So again, I think we're just getting jawbone here, folks. Take a look at the Also, take a look at gold prices in U.S. dollar correlation 10-year charts. Take a look at, there's our collapse right there. Gold is the orange line. And if you lay these if you invert that gold or silver line, I mean the gold and the dollar over each other, you'll see they almost follow each other as well. Take a look at that right there. And then through here, and where is 2012? There we go. 2012 is when basically that market kind of collapsed right about here. Gold market started going down in, there we go, October 2012. Gold at 1790, and the dollar starts to rise in value as well. There's where the two kind of intertwine. This was a crap market for gold from this point on. But again, take a look at this. The dollar is not as strong as it was right here, when gold was at doing nothing. And then take a look at this. The dollar's at 116. Gold's rising up there. So anyway, I'm just kind of going over stuff we've talked about over and over, and I was just pointing out here our last bull markets in gold. There's one right there in 2000, and there's one right there. Look at the strength of the dollar. The dollar strength was pretty high. About the same time gold was high. So the idea that stronger dollar and that raising interest rates is definitely the death of gold is a bullshit narrative. Again, I keep trying to point this out to a lot of you folks here. I don't know where this narrative gets painted, but you hear it all the time on CNBC, Bloomberg, Walls. I hear it from people that heard it from other people. Well, if if interest rates with the Fed, if the Fed raised interest rates, it's going to kill the price of gold. Bullshit, bullshit, bullshit. They'd have to raise interest rates probably to 8% or some crazy number like that. And speaking of 7 or 8%, a friend of mine called me about this. Did you know you get a risk-free bond that pays 7% annual interest for the next 6 months? Yeah, that's a real bond, folks. I said, wow, that's kind of interesting. It's called an inflation bond that the Treasury Department's put out. Pays 7%, can change in 6 months, obviously, and I don't exactly understand the terms of I-bonds, but here's what it is. I-bond, an inflation-protected, nearly risk-free asset, nearly risk-free. Well, I wonder what nearly means. We'll pay, I've never heard I have never actually heard a government bond or something being called nearly risk-free, but that's interesting. We'll pay 7.12% annual rate through next April, which may be attractive to those seeking relatively safe portfolio options. However, the rate increase may be temporary and there are restrictions to consider before buying, financial experts say. So they got a 7.12% bond out there, but here's the kicker. You can only buy up to $10,000 worth, so I'm really not quite sure what the whole point of that bond is. Really don't. Maybe to make bond buying attractive to average Joe out there, but you can only buy up to $10,000 per person, and I guess there are some risks there. But if the Fed's offering an inflation bond at 7.12%, what does that mean that real inflation really is? It's got to be higher than 7.12%. Do you think we're at 8, 9%? I didn't really look to see where we are when it, what realistic inflation is. Hang on one second. Let me see if I can. Oh, you caught me. This is what I do on my off time. I watch orangutans drive golf carts. Oh, this video made me laugh. Sorry about that. I was just going to go over here and take a look at. Hang on one second. Let's take a look. What is actual inflation rate? Let me see if I get a return on that. What is the current U.S. inflation rate? Current annual inflation rate for 12 months ending in October 21 is 6.22%. Okay, they were calling it 6.22% in October. Based on the fact that this particular inflation bond 7.12%, I can only assume that the rate is higher than that now. The current inflation rate's got to be higher than 7%. So what are we really in? What's our real inflation rate right now? I don't even, it says not 15%. I'm going to guess that it's probably closer to 10 to 12% or higher. But no less, that's just speculation on my point. You guys can guess that as well as I can. But take a look at this, 7.12% on an inflation bond by the U.S. government. But you can only spend up to 10 grand, and there are risks here. If you're interested in this, which, you know what, I wouldn't. In my opinion, I'd rather own gold or silver than even own this thing at 7.12%. I think gold and silver is a much safer bet. And as far as being a safer bet, I also think it is risk-free as opposed to being nearly risk-free, as they say right here. Well, let's move into yesterday's video. I'd like to thank everyone for watching. If you're new to my videos, make sure you hit that like button and that subscribe button. I do appreciate that. And hey, feel free to comment as well down here. Got any questions, feel free to ask me. I've got a couple questions I might want to answer here. Let me just blow that up a little bit. Move this over, and sorry about that. And let me just set this to sort by newest first. Don't ask me why I do that. And then of course I go to the bottom page to the oldest. Thank you guys. The debt hole, exactly. First time channel, thank you very much. Comment for the algo, like and subscribe. Thank you. Thank you. I really appreciate that. Knife Collector says, trying to find an answer to the question, will the magnet test work on a Grove Krugerrand? I have heard it will not. There's no magnetic properties since it's not 9. A little bit confused on what you're referring to there, Knife Collector, but the magnet will, obviously magnets will not stick to gold or silver unless there's some iron content in it. And have we seen gold with iron in it? Yes, we've seen silver with iron in it as well, mixed in improperly. But will a magnet stick to pure gold? Absolutely not. It won't stick to pure silver. That's where you use the magnet primarily to see if it's got any magnetic properties. And when you're talking about sliding a magnet down a gold bar or a silver bar, I forgot what the name is for that. There's a name for that when you feel that little pushback. It has something to do with the gold and silver. I think once you add alloy to a gold or silver coin, you don't get that pushback. So really, the magnet test is probably only good on truly 24 karat gold and pure silver as far as that little, when you slide it down the coin, you slide it down the bar. Hard to explain. Some of you are familiar with what I'm talking about, and maybe I'll do a video on that as well. But no, probably would not work on a Krugerrand and would not be the best way to test a Krugerrand. The best way to make sure you don't get burned with gold and silver is to buy from a reputable dealer. Avoid buying on eBay. Avoid buying from people you don't know or friend of a friend, no matter how well-intentioned they are. Buy from reputable dealers that know what they're looking at. That's my best advice. And you're a knife collector, you know that. Buy from knife collectors that know what they're doing. Expensive ass blade. People shouldn't be buying off the internet or trusting someone just because they said it is. Buy from legit people that know what they're doing. And you're pretty much assured you're never going to get burned. Hey, thanks for watching. Monkey hammer. There's got to be a monkey icon with a hammer. We got to get a monkey icon with a hammer for sure. Thanks for watching. Yeah, that's true. We were just talking about this, Mr. Manning, Thomas Manning. Meanwhile, the Fed continues to buy billions of mortgages each month to keep housing pumped. What a disaster. Look out below. Again, they're jawboning, I think, Thomas. I think they're just jawboning us. Are they going to start selling off those mortgages, or are they going to just reduce the purchases of that? I truly don't know that. So anybody that knows the answer to that question, is the Fed, besides tapering off the purchasing, are they also at the same time going to lay off the assets they purchase? Does anyone know this question? If you get a chance, put it in the comment section if you know, because I don't actually. This is true also, Mr. Manning. Hey, chart guy, what's up, dude? Appreciate you commenting. I always like your comments. The bullion banks cannot cover their short position without driving the price significantly higher. Cannot cover excess selling to push prices lower, requires more naked short selling. Consequently, BB's position increases where bullion banks increases where there's a number of contracts closed. As prices move higher, would be determined by how many new sellers are initiating sales. Which is necessary to buy back. Otherwise, prices have to rise higher to sell triggers. In other words, if the bullion banks had a means to cover their short position, they would have done, yes, exactly. That I'm aware of, and Ted Butler talks about that all the time. He says the shorts are in a current position right now where they're in approximately a cumulative loss of $8.5 billion. But you are correct there, sir, and thanks for commenting, chart guy. You're spot on there. I'm trying to understand the derivatives market more myself. I'm also trying to understand naked shorts, short positions, long positions, how to read the COT reports, all these things. So I'm kind of new to this too. So if I make occasional mistakes there, it happens. Again, I'm here to teach you what I'm kind of learning as I go as well. I hope you're enjoying the ride. Thanks for comments, 100 or bust. I appreciate that. Hey, what's up? And hey, thanks for commenting, Celtic Knot. You'll do 10 clapping push-ups. Man, that's pretty damn good. I don't think I can do more than 2 if I was lucky. Maybe 3. Brian, love to see the fish at the beginning of your videos. Hey, thanks for commenting. Michael, what's up? Coffee time. Short squeezes on. Buy physical silver. Can't argue with that at all. Here, let me get a quick sip of coffee. Well, I think we're going to end it at this, folks. Otherwise, we'll be here forever. This is Brian Kuzmar with Commercial Rare Coins and Precious Metals in beautiful, overcast, rainy Lauderdale by the Sea. Call me anytime between 10 and 4 p.m. at 954-493-8811. If you live in South Florida and you want to do business with us and you got questions, call us anytime. Unfortunately, we don't do any shipping and we don't do any online sales. So if you don't live in my area and you're one of the many people outside the state and outside the country that listen to my video, my recommendation has always been go find yourself a good local dealer. I know some of you buy online, some of you have no other choice to buy online, but I say even if you have to drive an hour or two to find and establish a relationship with a local bullion, coin dealer, whatever, that has fair rates, do it, man. It's very important. I think keeping the money in your state at the very least, and hopefully in your town, is the best way to do it, rather than shipping that money out of state to a place where it'll never be seen in your community again. On top of that, a lot of local people, like myself, I advertise to be APMEX, JM, and SD bullion. So I like to, and it's pretty easy to do that. I don't have the overhead they do, and I can buy like they can, and even better, I get a lot of advantages. And the fact that I can talk to my customers here face to face. You can walk in and talk to a real person here in Commercial Rare Coins and get face to face feedback. Not only that, it's much easier for a customer to feel at ease with someone when they're face to face with them and they have a good gut feeling with who they're dealing with. You can't have a gut feeling online, unless it's just a shitty website. But people, the biggest scammers out there have the most beautiful websites and claim to be the largest dealers. I mean, not all of them, but a lot of scammers do. There's no substitute for face to face business. I really sincerely believe that. Well, that's it. Call me if you want. Have yourself a great day, and I'll talk to you tomorrow. Bye now.